The $10,000 bank rule you keep hearing about is real. It is also from 1972, and it does not do what you think. Nobody at your bank files a report accusing you of anything for going over it. They file a currency transaction report, which is closer to a receipt. What actually gets an account flagged is breaking it up to stay underneath. This is for you if you are over 65. It is for you if you still keep some cash at home. It is for you if you have ever moved a few $1,000s to cover a roof, a car, or a grandchild's tuition. And it is for you if you have seen one of those videos warning about a new bank rule coming this year. Here is the number everything turns on. Not 50,000. Not 20,000. $10,000. Congress picked that figure in 1972 and has not touched it since. There are 4 things I want you to have straight by the end of this. What that form actually is, why the numbers stopped making sense decades ago. The one sensible habit that turns a legal deposit into a federal offense, and the protection you already have, which almost nobody mentions. I will walk you through all 4 using one man. His name is Wendell. He is 69. He did the careful thing, and it nearly cost him his account. The part of his story that matters most lands near the end, and it is the part I would want my own father to hear. Let us start with the thing everyone gets wrong, because everything else follows from it. Banks in this country have to file a currency transaction report when a customer moves more than $10,000 in cash in a single business day. Deposits and withdrawals both count. That comes from the Bank Secrecy Act, and it has been the law for over 50 years. Now hear what that form is not. It is not an accusation. It is not an audit. It is not a suspicious activity report. It is a record that a large cash transaction happened, filed automatically, on people who have done nothing wrong at all. The teller is not deciding anything about you. A threshold was crossed and a form went out. Here is the part that should settle your stomach. In October of 2025, 5 federal agencies put out joint guidance answering this directly. The Financial Crimes Enforcement Network, the Federal Reserve, the Federal Deposit Insurance Corporation, the National Credit Union Administration, and the Comptroller of the Currency. They were asked whether transactions sitting at or near $10,000 are enough on their own to require a suspicious activity report. Their answer was one word: no. Being near the number is not evidence of anything. A bank needs an actual reason to suspect you are trying to hide something. Sitting close to a threshold is not a reason. So when Wendell walked into his branch to take out $12,000 in cash, the honest answer is that almost nothing would have happened. A form, a record. No knock at the door. So if the form is routine, why does it feel like the net is tightening around ordinary people? Because it is. Just not for the reason you have been told. $10,000 in 1972 was a great deal of money. The Government Accountability Office ran the arithmetic and published it in December of 2024. Adjusted for inflation, that same threshold would sit at roughly $72,880 today. Read those 2 figures next to each other. 10,000. 72,880. The rule was written to catch people moving what was then a fortune in cash. It now catches a man buying a used truck. The consequence shows up in the filing numbers. The same report found currency transaction reports have climbed 62% since 2002. Americans did not get more criminal. The dollar got smaller, and the number stayed still. Think about what that drift means at the counter. A figure that once described a suitcase of cash now describes a used car, a new roof, a year of care paid up front. Nothing about the transaction changed, and the person writing the check certainly did not change. Only the size of the dollar changed, and the rule never noticed. I want to be careful and fair here. Nobody sat in a room and decided to point this at retirees. There is no plan. That is almost the harder thing to accept. A figure was set in 1972, It was never indexed to inflation, and over 54 years it drifted quietly down onto ordinary people who were never the target. Wendell is one of them. He is not a suspect. He is a man whose money is worth about 1/7 of what the rule assumed. Now here is the turn, and it is the reason I made this video. Wendell needed $11,000 in cash for a well and a new pump on his property. He had it saved. But he had watched a video telling him that $10,000 gets you reported, and he did not want the trouble. So he did what a careful person does. He went in on a Monday and took out $6,000. He went back on Thursday and took out $5,000. 2 withdrawals, neither one over the line. He thought he had been sensible. What Wendell actually did has a name. It is called structuring, and it is a federal crime under Section 5324 of Title 31. Understand the shape of this. The $11,000 was his. It was legal, taxed, and saved. Taking it out in one go would have generated a routine form and nothing more. Splitting it in two to stay under the number is the part the law actually prohibits. The crime is not the amount. The crime is the avoiding. I want to be precise because this matters. Intent is part of the offense. The law asks whether the transactions were arranged for the purpose of evading the reporting requirement. Somebody who happens to make small deposits because that is how they have always banked has not committed a crime. Somebody who splits an amount specifically to stay under $10,000 has. Structuring carries civil and criminal penalties. And here is what stings. The advice that got Wendell into trouble is the advice those videos are handing out for free. They tell you the number is dangerous. The only genuinely dangerous thing you can do with that number is manage your life around it. So if the amount is not the trigger, what is? In December of 2024, the same federal banking agencies, along with the Consumer Financial Protection Bureau and state regulators, issued a joint statement on elder financial exploitation. It is worth knowing what is in it because it describes what your bank is genuinely trained to notice. It is behavior, not size. A transaction that does not match how you have banked for 20 years. An unexpected large wire, especially to someone new. A caregiver or a relative doing the talking while you sit there quietly. A sudden change to who inherits the account. A new name added to a lifetime of statements. And here is the detail that reverses everything you have been told. Banks may file a report voluntarily on amounts far below any threshold. If a pattern looks like an older person being pressured, the dollar figure is beside the point. $900 can be reported. $90,000 can pass without comment. I want to be fair to the banks here because it would be easy not to be. The reason a teller looks twice at an unusual withdrawal is that a great deal of money genuinely does get taken from older people, and the person taking it is very often somebody they already know and trust. The training exists because the harm is real. A bank that notices nothing at all is not protecting your privacy. It is simply not looking. The scale of this is not small. The Financial Crimes Enforcement Network analyzed filings from June of 2022 through June of 2023. In that single year, there were 155,415 filings tied to elder financial exploitation, covering about $27 billion in suspicious activity. I will be straight with you about what that number is. It measures reports filed, not crimes proven, and the agency says so itself. But it tells you where the attention is. Nobody is staffing a room to watch Wendell buy a pump. They are watching for the nephew who suddenly has the password. Now, the thing I have been holding, because it is the most useful minute in this video, and almost no one covering this subject will tell you. The law already changed, in your favor. For years, the real danger was not the report, it was seizure. Federal agents could take the entire contents of a bank account on the appearance of structuring, with no charge filed and no conviction, and the owner might wait years for a hearing. It happened to small business owners and farmers who had never been accused of anything else. That ended on the 1st of July, 2019. A law called the Clyde-Hirsch-Sowers Respect Act was signed, and it did two things that matter to you. First, the Internal Revenue Service now has to show the money came from an illegal source or was being used to conceal illegal activity before it can seize funds for structuring. Money that is simply yours is no longer enough. Second, if a seizure does happen, you are entitled to a prompt hearing, not a wait measured in years. It is named after two men. Jeff Hirsch ran a convenience store distribution business. More than $400,000 was taken out of his company account over the pattern of his deposits. Randy Sowers is a dairy farmer. He lost $29,500 the same way. Neither man was ever charged with any other crime. Neither was accused of drugs or fraud or hiding income. Their money was simply the wrong shape going into a bank. Both eventually got it back, and the law now carries their names. So look at what has actually happened while the videos were warning you. In 2019, the seizure power was narrowed. In 2025, the agencies said plainly that being near the threshold is not suspicious by itself. Two corrections, both protecting you, and neither one gets mentioned. Wendell was frightened by a rule that had already been softened twice. So here is how you handle your own money, in 4 moves. 1. Move what you actually need in one transaction. If it is $14,000, take out $14,000. The form is routine, and it is not about you. 2. Never split an amount to stay under the number. This is the whole lesson. Splitting is the only step in this entire subject that creates a legal problem where none existed. 3. If the teller asks what the money is for, answer plainly. A well, a car, a wedding. Ordinary answers are what ordinary transactions sound like, and there is no advantage in being cagey about your own savings. 4, and this is the one I would press hardest. If someone is standing beside you at that counter and doing your talking for you, that is the pattern the bank is actually trained to see. If that person is helping you, no harm is done. If they are pressuring you, the bank noticing is the best thing that happens to you all year. And one thing you can stop doing entirely. Stop treating the number as a line you must not cross. It is a filing threshold for the bank, not a speed limit for you. Nobody is scoring your restraint, and there is no reward for staying under it. Wendell took the $11,000 out in a single withdrawal the second time. He answered one plain question about the well. A form was filed somewhere he never saw. Nothing else occurred, and the pump works. If this cleared something up, press the like button and subscribe if you would like more of these. I go through one retirement rule a week, slowly, with the sources on screen. Your one step today. If you have been keeping your withdrawals under $10,000 on purpose, stop doing that. Move what you need in one transaction. That single change takes you from the one behavior the law actually punishes back to the one it ignores. I am not your attorney, and I am not your accountant, and your own circumstances can turn any of this. If a seizure or a bank inquiry has already touched you, talk to a lawyer who does this work, because the two protections I described are worth someone knowing how to use. Here is the wider thought I will leave you with. The number that governs your bank account was set before the first mobile phone call was ever made, and it has not moved once. It will keep drifting down onto more people every year until somebody indexes it. Knowing that is not a reason to be afraid of your own bank. It is a reason to stop taking advice from anybody who tells you to hide from a receipt.